Hey everybody, it's Andy Panko at Taxes Retirement. Hope everybody's having a great day. I'll wait for a few people to come in here. Let's see if they show up. All right, let me see some comments. Just make sure we're live today. All right, we got a viewer, I think. Let's see if comments are working on my side. There we go. We got people rolling in. See if comments come in. If not, that's okay. I'll just have Andy come back and text me all of your questions along the way. All right, there's Mark. I see you guys. Awesome. So I am Andy Panko from Taxes Retirement. I'm going to make sure I put my glasses on. So ready to go through some fun taxes information, getting prepared to go to and through retirement. Actually, I want to say this. All right, that's my sense of humor. Let me get my. There we go. More people showing up. All right, let me get my display name. Here we go. So I am not Andy Panko. I am Cody Garrett. I'm a certified financial planner. I'm one of the moderators along with David Foltz of Taxes and Retirement. We're also excited about, of course, taxes and retirement, but really just passionate about financial education, helping others make better, like well-informed decisions about their finances and their money, and really go beyond the numbers, really think more really personally about personal finance. So tonight, Andy has asked me, actually, for the coming months, I'm going to do once a month. I think it's the second Wednesday of each month. Andy's going to take off and, so he can lay down in his hammock, take a little break. He's probably watching right now because he's such a nerd. But he's allowed me to share some financial education. I'm not sharing any advice, right? Well, I'll certainly show the disclosure slide as well. But I'm going to share financial education and really show you, like under the hood, behind the scenes, what it looks like in terms of reviewing financial documents as a financial planner, right? Going beyond the basics and looking at quantitative data in a very different way, in a very personalized way. So I'll go ahead with the disclosure slide. So this video is not general explanations and education. Sorry, this video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. And I hope that they're doing good work for you. All right, thank you. I will go back. Here we go. So let's make sure. Good, comments are coming through. Hello, everybody. So get back. I'm getting used to all this fun stuff. So I'm going to go ahead and start with the dad jokes. I know that we'd be really bummed if I just missed that opportunity. So since Andy's taken the night off, I've looked at some dad jokes that relate to tonight's subject, which is debt and mortgage debt specifically. So here we go. So I thought people would flock to my bank when I offered 0% fixed rate mortgages, but there was no interest. All right, that one's kind of lame. What do you call a woman who sets her mortgage documents on fire? Bernadette. Get it? Like she burns the debt. And then lastly, what do you call an aging actor who has finance? I'll say this one again. What do you call an aging actor who has paid off his house? Mortgage freeman. Get it? Like Morgan Freeman, but mortgage free. Wait, let me get the laughing video for you, David Folt. All right, I'll never get over that. So what I want to do tonight, I'm going to dig into how to review a mortgage statement. And more than that, just going around these conversations we have in debates sometimes about, hey, should I pay off my mortgage more aggressively than minimally, or should I invest the rest, right? Take advantage of especially framing against these past market returns or other investment opportunities. So I'm going to share with you kind of the outline of what I'm going to be doing over the next few months first. So I'll go ahead and pull that up. So what I'm going to be doing the second Wednesday of each month moving forward is helping you really see how I review financial documents really in a deeper way. So I have this data gathering checklist. I think Andy or Yeah, Andy might be able to, Andy or David might be able to, put the link up here for this. I'm sharing this PDF document with you so you can follow along. But this is the data gathering checklist that I request documents when I'm working as a financial planner. And this is really, I call this everything in your life with a number on it, right? So I have real assets, like I need to know where people live. That includes looking at things like appraisal district websites, really understanding really how the family lives, how close are they to where their kids go to school, right? Like how close are do they live to their church and their siblings, right? When we're talking about estate planning. So looking at real estate addresses, investment statements, certainly we're all familiar with these in the group. I will be doing a deeper dive on how to review investment statements as well. Tonight, the focus is on liability statements, specifically mortgages. You can see that, just 1 week dedicated to mortgages, whereas like there's probably like 40 different documents here. But we're going to be focusing on mortgages and then debt more broadly at the end of the presentation this evening. The income and expenses, right? Pay statements, understanding this kind of ties pay statements along with employee benefits, really understanding your earnings, your deductions, your taxes, like where's your money going, along with really where is your net income going in terms of annual living expenses, social security statements, and so forth, right? There's a lot of documents here, and tonight we're specifically going to focus on the mortgage statement. So if you could also follow along tonight using your own mortgage statement, but I like to have fun. So I went ahead and created a real fake mortgage statement. This one specifically, I have somehow become a mortgage servicer. This is Measure Twice Credit Union, right? So I've branded this in terms of Measure Twice money, but every other piece of information on this document is from a real mortgage statement. So hopefully I've taken everybody's confidential information off of the sheet. So to get started, we're going to talk about the things you'll see at the top of the page, right? You're going to see the mortgage servicer's contact information, right? In case they get something wrong, you need to you'll know where they live, right? Then you have whoever the mortgager, right? Typically the person who owns the house, right? This Susan Sampleton, she lives on 401 Kangaroo Drive in Roth, New York, which is the only tax-free bureau of New York, by the way. And then you can see the property address, right? Sometimes the property address is going to be different than the address where they send the mail, right? This is specifically going to be different if this is a rental property, for example. So you can see this is the primary residence. 401 Kangaroo Drive is the same as where they're sending the information. You'll see up here the statement date. So this is interesting. The statement date is actually, it's not the date that you receive it in the mail or the date that they mail it to you. It's the date where they calculate how much of your monthly payment is going to go toward interest versus principal, right? So they will take your interest rate, divide it by 12, multiply it by your outstanding principal, which we'll get to in a moment, right? On that closing date. So that closing date is typically 20 to 30 days before the due date, right? You can see there's a payment due date and there's a statement date. So these are typically different. So there's December 4th of 2020, right, is when they really calculated how much interest would be a part of that fixed monthly payment. And then you have your due date, right, which is typically like the first of the month. Right. So down from there, certainly all your contact information for if you have any issues with your mortgage payments along the way. So let's see here. I've got some notes. So in terms of the property address here, we look on the left side, account information, right? We have outstanding principal. So this is the balance as of this statement date. So not as of when you're reading it, but the statement date, when the closing date. This is the amount of the loan that's outstanding. So like this is how much is remaining on the mortgage, right? You'll notice there's a little, most mortgage statements will show this as well. The outstanding principal balance is not your payoff amount, right? So if you actually want to pay off your mortgage in full, let's say you had $10,000 left in your mortgage, you want to make just like a big final payment, right? If you just sent them what you see here, you'd probably get one more bill, right? Because since this closing date, you've probably actually accrued some interest along the way. So if you want to pay off your mortgage in full with your last payment, you go ahead and call customer service and ask for the current payoff quote. So the maturity date, right? So the maturity date is when the loan is expected to be fully repaid if you only make minimal monthly payments moving forward. So the maturity date here, you can see the statement date is December 2020, and the maturity date is April of 2050. So you can immediately tell this is a 30-year mortgage, and we're about like 6 months in to the 30-year mortgage. So the interest rate, you see that this is a fixed interest rate because it says until the maturity date, right? 2.875, right? I wish I had a 2.875% interest rate, but I refinanced my loan just a few months early in 2020 when all the rates went down. So the interest rate is the annual cost of borrowing. So each billing cycle, your interest rate divided by 12, right, is multiplied by your principal, your outstanding principal balance, to determine the portion of your monthly payment that is allocated to interest versus principal, right? Let's go ahead and move over to that section. So the explanation of amount due, right? You have your principal balance. Sorry, this is splitting up your monthly mortgage payment. So your principal here, right? He's paying, in this case, Susan, she is paying, $894.81 of her payment is going to actually pay down the mortgage principal, right? Then you have this larger portion, right? We'll talk about why that's larger. This larger portion is going to pay just the interest, really the cost of borrowing for that month, right? I've gone ahead and calculated that over the next 12 months, right, Susan will pay about $11,000 in the next 12 months will go to principal, and about $14,000 will go to interest. I'm going to go ahead and show you an image to show how this happens. So I've got a lot of details to show you if we get time. Let me check the comments. Perfect. Everybody's saying hello. Awesome. Bernadette, Andy. There we go. So the mortgage payment breakdown, right? So what I'm showing here is if you actually amortize a mortgage, so you want to see, hey, like how much, your fixed payment, right? I've taken a $350,000 fixed rate mortgage at 3% over 30 years. So that's 360 payments, right? So 360 payments of $1,475.61 in this case, right? So this is an amortization schedule showing which portion, how much of that $1,475.61, right? I've actually done it on an annualized basis. So if I do that multiplied by 12, so if you had a $350,000 mortgage, 3%, 30 years, you'd be paying $17,707 a year toward principal and interest payments. So you can see, right, the larger, right, since the mortgage, the outstanding principal amount is the largest when you first get the loan, right? That's when you're going to pay, more interest than principal, right? Like over the scale of the whole mortgage, the full repayment period. So you can see in the beginning, you pay more interest than you pay on principal, right? But each of these years, if you add these up, that equals that 17,000 that we talked about, 18,000. So not until over a 30-year fixed rate mortgage, you do not cross the barrier of paying more principal than interest on an annual basis until actually the first month of the 8th year is when you actually cross that threshold, start paying more principal than you were in interest on a monthly and annual basis. Another fascinating thing about this is because you pay the outstanding principal is the largest in the beginning, right? You end up paying, you can see here, $93,000 in interest over the first 10 years of that 30-year period, right? Which is about half, right? About half of the total interest over the whole life of the 30-year loan is paid all within the first 10 years, right? That doesn't mean that it was front loaded. Like, it's not like, if you were to just start a mortgage, however the principal payment, the outstanding principal amount is in year 11, it's not like you've been, they got you. They made you pay it all up front. It's just simply because the mortgage principal was the largest at the beginning of the loan. So you pay about, over the full period, you pay 50% about, using these metrics, 50% of the total interest is paid within the first 10 years. And then look at the last 3 years of the mortgage, right? So, sometimes people get to this like last 3 years, or like, should I pay off my mortgage early or not? Like, if you're looking in the grand scope, right, you can see that at the end, you're going to notice that most of it is actually paying down the mortgage principal, and most of that interest was paid in the front end. One common misconception about if you have a home with a mortgage is people will sell. Let's say they get a $350,000 mortgage, right? They end up selling their house. Do a little quick math here. So let's say they actually didn't put down a down payment at all. Let's make it simple. So they bought this house for $350K, right? It all went into a mortgage. They end up selling their house, right, for $400,000. They're like, I made $50,000 on my house, right? But when we add up all the interest, we need to understand the true cost of home ownership along the way. If you have a mortgage, the total payments on that $350,000 mortgage end up being $531,000, which is about 52% higher than the original outstanding principal balance, right? So I'm not saying that it's bad to have a mortgage, bad to have a primary residence, but I would love for more people to understand that a primary residence is more of a lifestyle decision than an investment decision. So when you do sell your property, you have to, you don't receive any benefits from, like rental property in terms of, depreciation over time and depreciation recapture, right? But you are going to it's just important to realize that, you are paying more than what you just simply sign up for in the beginning, unless interest rates somehow, go to zero moving forward. So finishing off the mortgage statement, so P and I, right? So principal and interest is often called P and I. And then you have escrow, right? So escrow is essentially a forced savings account, right, that allows your mortgage lender to disperse your property tax payments, T, and homeowners insurance payments on your behalf throughout the year. So you'll see that's P, I, T, and I, right? One thing that the mortgage lenders use when calculating, whether to give you a prime rate mortgage is they take these letters, PI and then TI, taxes and insurance, and they create what's called a housing ratio. Let's see down here. So here's an example of that housing ratio in this circumstance, right? You see this graph in the middle. So, to see how much you can quote unquote afford, again, these aren't necessarily metrics that you should use for your household, but these are kind of industry benchmarks for how much you can afford in terms of housing debt. If you add the principal, so these aren't these monthly, you add the principal payment, the interest payment, the taxes, and the insurance, PI, TI. If you multiply that by 12 to make it annualized, right, that'll become the annual housing payment, right? So for that mortgage statement we were reviewing, that ends up being about $43,000 a year. So, it's definitely a lot of money, right? So you think about maybe your own circumstance, like could you afford, right, to pay just toward housing, right? And that's before any utilities and things, right? Just principal, insurance, taxes, and insurance. Like, would I be able to afford, $43,000 a year out of pocket, right? So the mortgage lenders do this to make sure that you're taking on really healthy leverage. Sometimes we consider a mortgage good debt, as long as it's reasonable and you can afford it along the way, right? So the way mortgage lenders do this is they divide this PITI amount. They divide this into your gross income, or kind of for this circumstance, right? So we didn't start off with gross income. We just know how much this PITI cost in this circumstance. We can divide that by 28%. So the housing ratio is 28%, right? So PITI divided by gross income should be 28% or less to be within that healthy benchmark, the industry's benchmark, right? If you add other debt payments, so let's say you have an auto payment, you've got some credit card payments as well, they're going to add that to it. So PITI plus all other debt should be, equal to or less than 36% of gross income. Again, these are industry benchmarks. I would encourage you to maybe have conversations with your family, your partner, your spouse. Say, hey, like, do we want to define our own metric, right, of healthy leverage, on our mortgage? So let's say, so my wife and I, we might want to say, hey, let's try to keep all of our debt all of our debt payments like within 25% of gross income, right? Or we may push that even more, right? Just to, if we're more risk averse, we could say we want to keep all of our debt payments, within 25% of net income, actually after income taxes, right? So I just want to encourage you, yes, like understand these kind of rules of thumb, these benchmarks, but one size fits all really doesn't fit everybody, right? So go ahead and create metrics for yourself and calculate these things to figure out where you stand and where you'd like to moving forward with your family. So I will come back to comments if we have any soon. But so finishing off the mortgage statement here. One thing that's not on this mortgage statement that I wish was on it, maybe we'll add it here, is PMI. So you may see something on your mortgage statement called PMI. It's primary mortgage insurance. So what this is effectively, usually if you have like a conventional loan and you don't have at least 20% equity in your home, right? So you look at the fair market value of your home. So if your debt is more than 80% of your fair market value of your home, right? With a conventional loan, you're most likely paying PMI. So primary mortgage insurance, it's really, you're paying the insurance, right? You're paying the lender's insurance to really protect them if you stop making payments and default on the loan, right? So again, this is usually required if you have a conventional loan, a non-government loan, and you make a down payment of less than 20% of the home's purchase price. So here's a key thing that I would hope that at least one person listening does this and maybe can eliminate some future payments. So there's two ways to eliminate PMI since we talked about that 20% threshold. So one is you could make additional principal payments, right, to end up having 20% equity in your home, right? That does definitely, that can weigh on your cash flow, especially if cash flow is already tight, right? So that's option one. But the other option is you can request what's called an external appraisal, possibly. So you can request an appraisal to reevaluate the current fair market value of your home, right? For your, your service lender, so your mortgage lender to really reevaluate your equity percentage, right? So, giving my own example, a few years ago, I had about 3 years left of PMI since I didn't put down 20% on our home. So I was paying about $90 a month, right? So I was paying about $90 a month for PMI. So over the next 3 years, I was expecting to pay another about $3,200 toward the lender's insurance, which I didn't, I knew that I was, going to be able to pay off this loan and had a healthy emergency fund and cash flow coming in, right? So what I did is I called my mortgage lender and I requested what's called an external appraisal. So I literally paid $100 to have a guy drive down the street and kind of walk around my house, go, yeah, this house looks nice. I mean, I'm sure it was a little bit more than that, right? But I end up getting a call a week later. They're saying, hey, the external appraiser went out. He looked at your house, kind of compared it to other houses that have sold in the area. He says that, like based on that, we've increased the fair market value assumption of your house. Now you have over 20% equity, and they eliminated the PMI payments. So by spending $100, I eliminated $3,200 in future PMI. So I hope that encourages some of you to take some action, especially if you calculate your outstanding principal, right, on your mortgage statement, divide it onto maybe what, I know Zillow's typically pretty high, right? But look at your appraisal district and look at other websites and say, hey, like, is my outstanding principal like less than 80%, right, of the fair market value, and I'm paying PMI? I want to go ahead and call that lender to have that eliminated as soon as possible. So moving down here, you'll see that there's a breakdown of what you've done, where all your payments have gone, last month, right, and paid year to date. One thing to take note of is your principal. Every month, your mortgage statement, this is kind of fun if you want to look at it every month, your principal every month, that payment will go up and your interest payment will go down, right? These together will always add up to the same amount. If you've got a fixed, typically, 15 or 30 year fixed rate mortgage, right? So these P&I together will always equal the same amount, but you'll be paying more toward principal if you like to have fun that way. So lastly, on the bottom of your mortgage statement, you'll typically have this payment coupon, right? This is if you actually want to get something called a checkbook. I'm not really sure if they make those anymore. And you can, mail in your coupon along, you can mail in this coupon along with your check, right? But of course, if you scroll up to the top of your statement, you probably also have online, right? You can pay your bill online. You can set up auto pay often from your checking account. One quick note about escrow, right? So we talked about escrow being kind of like a forced savings, right? So whether or not you have an escrow account really depends on the type of mortgage, right? How much equity you have in your home and your payment history. So government-backed HSA and USDA loans require an escrow account, right? Whereas conventional non-government loans may or may not have like unique requirements, based on your servicer. So one thing to note, though, right? If you aren't saving, kind of having this forced savings of taxes and insurance, to use your property taxes and your homeowner's insurance and flood insurance and things like that, windstorm, right? If you don't have an escrow account, it might be a good idea, right, to earmark these funds for the upcoming year within a separate savings account, right? And I also encourage you, right, because these are anticipated expenses, these are not unexpected. You might get the bill and go, oh no, like I'm gonna have to pay $10,000 for taxes and insurance, right? Like since these are anticipated coming up, like these should not commingle with your emergency fund, right? Because it's anticipated, not an unexpected event. So I do encourage you to kind of, if you've got a big emergency fund, kind of cash slush bucket, make sure that you have your emergency section separate from money that you actually intend and anticipate to spend within the next year. So one thing that mortgage lenders and realtors typically say when you're buying a house is they convince you to get like the more expensive house. And one way they do that is by saying, oh, well, there's a tax benefit. You're going to get a tax benefit. If you, yes, you have a mortgage and you're paying a lot of interest along the way, but at least you're going to be able to deduct that interest, right? So just a couple years ago, Tax Cuts and Jobs Act, like the standard deduction. So the amount so you take your adjusted gross income on your tax return, you get to reduce that by the standard or itemized deductions, and then the QBI deduction, which is kind of beyond the scope of tonight's presentation. But you have your standard deduction. So this amount practically doubled a couple years ago, which means if you don't itemize, right? If you don't have so itemized, where are they here? I just made a little note here. So itemized deductions are typically your state and local taxes, right? So those are actually capped at $10,000 right now. Like there's conversation about whether that cap will be raised, but right now it's at $10,000 plus mortgage interest, like we talked about, right? So this mortgager, they were going to pay about $14,000 in interest, this coming year on this loan, plus charitable contributions, plus medical expenses that have like an 7.5 AGI floor. But really, if you add up your itemized deductions, right, and if they don't end up being higher than your standard deduction, you actually get no additional tax benefit from having mortgage interest, right? So, Susan up there, if let's say that she had her $14,000 of mortgage interest, her $10,000 of state and local taxes capped, and she didn't do any charitable contributions or any like major health expense, medical expenses, right? She actually wouldn't get any additional benefit on top of what the IRS already gives you in terms of the standard deduction. And you can see that if you're age 65 or older, you get an additional standard deduction, yay, right? And this is per spouse if you're married filing jointly. So a quick note on the tax, just to figure out whether or not you're actually getting a benefit from your mortgage interest, or if that's something that, it's something people toss around a lot, but that changed because of the standard deduction being practically doubled a couple years ago. So I'm gonna look at the comments, make sure, oh wow, there are more. Let me slide these forward here. All right, here. Sorry, I'm just looking for question marks. So in terms of, there's a note about what's the difference between single filer and head of household, right? So the head of household here, or I'll go back to my little sheet. So the head of household requires that you have a dependent, right? That that really you're carrying. You at least pay for over really half of the care for a dependent. As you're technically a single filer, right? But you have a dependent, with you. And then there's also not on here is the qualified, widower filing status, which is the year after. Sorry, I think the 2 years following. So if your spouse were to pass away, you'd still file married filing jointly in that year of death, but you could file the qualified widower the next 2 years, but you still have to have a qualified dependent to claim that status. So same thing here at the head of household, you have to have a qualified dependent as well. So I see a lot of good notes, not a lot of questions yet. So I'll jump back into the boat. All right, here we go. Hide. There we go. So I want to do some fun things. I want to analyze this mortgage, right? So you have hopefully you have the PDF with you. So the explanation of amount due, now that we have the principal, the interest payment, and we have the outstanding principal, and we have the interest rate, we can have fun. My version of fun. So we're going to analyze the mortgage together, right? So again, here's the outstanding principal. Thankfully, I brought it all onto this page. So outstanding principal, interest rate, the monthly principal payment, and the monthly interest payment, which together make really the monthly payment, like excluding the escrow, taxes, and insurance payment. So there are two calculators that I just put on here that you can download if you want to play around as well. One is the 10B2 calculator phone app, which is like my favorite thing in the world. When I'm not on Facebook, I'm on my 10B2 nerdy calculator. And then there's also an online free version, which is just a basic time value of money financial calculator, which actually has some issues with. So I'm going to stick to showing you what it looks like on the 10B2. So let's say when I look at this mortgage statement, I want to know how much time, right, is remaining on this mortgage. First of all, paid minimally, but then we can go down this rabbit hole of like, oh, well, how much do we need to pay to, if we want to, pay it off by a certain age, right? Or if we want to turn this 30-year mortgage to a 15-year mortgage, right? We can do this just with a basic time value of money calculation. So going down, I'll go ahead and show you the picture of the calculator. Look at that, fun. So on the right side, this is what that calculator looks like on my phone, right? First of all, my battery went from 28% down to 25 within 1 minute. So I think I'm going to get a new phone soon. But moving into the calculator, you can see that there's on the top of the financial calculator, every financial calculator has these letters. So there's N, which is the number of periods, right? This is typically like months or years, right? Your interest rate, we'll talk about what you need to type in there in a minute. Then your present value, right? And then your payment. And then, so, payment per period, per N, and then your future value. So let's go ahead and run down what we type into a financial calculator. So going up here, now that we have these numbers, right? The N, that's actually what we're solving for. So we want to know how many months, how many years is left on this mortgage. David Foltz loves the calculator. I love it. Then we've got their interest rate. So this is what's funky about a financial calculator if you haven't used it yet, is the periods per year are like automatically set to 1 per year, right? So we need to, because we make 12 payments per year, right? Their interest rate we type into the calculator is actually going to be the annual interest rate, so 2.875. Then we're going to divide by 12 because there's 12 equal payments per year. The present value, right, is actually going to be the current mortgage value, the current outstanding principal balance, right? And you'll notice that there's some like positive or negative numbers in a calculator, right? So we're doing this as a positive number, right? Because we have to think of the mortgage, the money that we received to pay for the house, right? We received that loan as an inflow, like they gave us the money to buy a house, right? So since it's coming to us, where it's a positive inflow, positive cash flow. So on the payment side of the equation, since we're paying this $2,000 a month, right, which is the principal payment plus the interest each month, this stays constant through the whole fixed mortgage. So this payment of $2,000, you notice that it's a negative number, right? So the reason that this number is negative on a monthly schedule is it's, this is actually outflows. This is money going out of our bank account, going away, bye-bye, never see it again, right? So again, present value is positive and payment is negative, right? So there's a negative number since this is an outflow. Lastly, the future value, right? What we're solving for here, right? Well, we already know that we want to fully pay off the mortgage, right? So the future value of this loan is going to be 0, and the present value of this loan amount is here, right? So this is what it looks like on the calculator. So number of periods is what we were solving for. So this will originally be like a question mark here, right? So your interest rate, again, we have the 2.875, but we have to divide that by 12, right? Because 12 months per year. So that ends up being 0.23% interest rate per month. The present value, the current outstanding principal balance. The payment is how much we're paying per month, excluding escrow. And then the future value is 0. So when we typed all these numbers in, right? If all you have to know is 4 out of 5, right? So we know these 4. So now the fifth, and what we're solving for here is the number of periods. So this comes to 351 periods, periods, and then a little bit left over. So if I do 351 plus a little bit, if I round up, right, that ends up being 352 monthly payments, right, to pay off the remaining balance, right? If I divide that by 12, that means I have 29 years, right? And 333 is a fourth of a year. So I have 29 years and 4 months remaining on the loan if I make only minimum payments, right? So if you're having fun with this math, I hope you're still here. And so, going into the amortization part of this calculator, this is the part I think is fascinating, is it will tell you how much future interest will be paid over the remaining life of the loan, right? And then the future cost of the mortgage in total. So the mortgage principal right now is $492,000. If we end up paying just minimally, no additional principal payments, then we're going to pay $730,000 over the next 29 years and 4 months, right? Again, this is 48% higher than the current balance because of that ongoing interest that we're paying. So this is a fun chart I made just to show you visually how this works. So making minimal monthly payments, you're going to pay about $2,000 a month, which on an annual basis is about $25K. So you're paying straight up $25,000 for this mortgage before taxes and insurance. So your future interest paid is about $230,000. Years remaining, 29. Somebody said fun. That's awesome. 29 years, 4 months. And then I assumed that the person who has this mortgage is age 50, right? So I wanted to show them, and in this example, hey, just to let you know, right? You're going to have this mortgage paid off when you're age 79, right? Like, what are your initial thoughts? Like, are you okay? Is that like, is this kind of surprising, right? I think we take out a mortgage, we sometimes don't think about money in terms of time. Like, hey, how old will I be by the time this 30-year mortgage is paid off, right? Not that we make the decision solely on how old we'll be, right? Some people, it makes sense, when they retire, let's say at 65, to actually get a 30-year mortgage at that point, right? It's not really based on age, right, in terms of your decision, but it is important to realize, yeah, I amortize. Cody amortizes for fun. I love that, Andy. Thanks. So right now, if 50 years old, they'll have this paid off when they're 79. But what's really great about now that you know how to use the calculator, right, is you can say, well, what if I want to pay off the mortgage before I'm on Medicare, or before I claim Social Security, right, or before I retire at 60, right? You can now back into that. Now N, right? So N is going to be the number of years, multiplied by 12 moving forward in your next calculation. But you can see if somebody wanted to pay their mortgage off by age 64, they need to make additional $1,500 a month principal payments, which actually ends up making their annual payment $43,000 a year. Again, excluding the taxes and insurance. The nice thing here, of course, is they save $130,000 in interest versus doing, not making any additional principal payments. Here's a picture of the amortization schedule on the left side of what the calculator shows you. So this is the stuff that's really fun to me that the phone version can do that sometimes like the old school calculators don't give you. Oh, sorry, you didn't see me there. I did that. That's the old school calculators don't give you. So moving down here, I want to talk a little bit about the case of, actually, before I jump into that, I do want to show you, there's a really cool to me. Oh, sorry. So Andy asked, can you recap why getting your house value appraised higher can get PMI waived, right? There's a question about that. So conventional loan, you're typically going to have to pay primary mortgage insurance, PMI, right, until you have 20% equity in your home, right? So if you take, you can call up your mortgage lender and ask them, hey, like, what do you consider the fair market value? Like, what do you consider the value of my home currently? And they'll tell you, right? Because they're keeping track of all this stuff, right? For example, this person has, that would be, yeah. So this person, like, in a typical world would have PMI at this level, but let's see here. 492. So I'm doing the outstanding principal amount divided by 0.8, right? So they're going to have 20% equity in their home, right? Only if their home is worth $615,000 or more, right? So I divided the outstanding principal balance divide by 0.8 to get to how much the house needs to be appraised for to eliminate PMI. So the reason that, getting your house revalued, right? So your only options, right, is you can reduce your loan amount or increase the value of the property. Right? Those are your two options for eliminating PMI. So since, we don't want to, let's say we don't have a ton of cash flow to just pay a ton of extra principal to increase our equity in the home, we can request an appraisal, right, for somebody to, come out, look at your home and say, hey, yes, I do think, we need to reappraise this, versus the appraisal on your home is typically going to be, when you first bought your home. That's probably the number they're still using, if not updated since then, right? So you call to get an appraisal. If it ends up being higher, right, then that means, you have a greater chance, right? You have a greater chance of having that 20% equity. As soon as you hit 20%, right? I think there's a timeline there, but as soon as you hit 20%, you better, get that PMI eliminated. If not, if you want to get it done more immediately, certainly you'd call up your lender and say, hey, let's reevaluate to make sure I have 20% equity and eliminate PMI. So it's actually worth giving them a call now. Go just a little note there. So I think, this is something where go ahead and just call your lender and say, hey, I have PMI. Like, what do I need to do to remove this? Maybe they'll walk you through those steps, right? Again, you're just paying their insurance payment effectively. So moving down here, I want to show you, a lot of people ask, hey, should I take out a 15-year or 30-year mortgage, right? There's a lot of variables, like personal variables, that go into this decision, but I want to show you how I really evaluate that decision. So I've taken this loan amount. So let's say the family is they need to get a mortgage of $350,000, right? Typically a 30-year mortgage rate is going to be higher than a 15-year rate, right? So right here I have a 3% 30-year rate and a 2.5% 15-year rate. So, using actually that same calculation we looked at earlier, we can figure out the monthly mortgage payment, right? So for the 15-year mortgage, the monthly payment is about $2,300. On a 30-year mortgage, because of this higher rate as well, right? The monthly payment on the 15 is going to be $2,300 versus on the 30, which is $1,500, right? The reason that it's more, right, effectively, is because you're paying off in 15 versus 30 years, right? You pay more to pay it off in less time, right? But you'll see that because you have a lower interest payment and you're paying it for less time, your total interest paid on the 15 is $70,000 versus $180,000 for the 30-year mortgage, right? So you see your total payments, right? You're paying about $111,000 more for the 30-year mortgage, paying minimally, than taking the 15, right? But you'll notice, right, that if you annualize this 15-year mortgage, that's monthly. So you have a $28,000 fixed annual payment on your principal and interest on this 15-year mortgage, versus the 30-year, you've just lowered your payment down to $17,000, right? So that's a big difference in cash flow, right? But you are going to, have to pay a lot more interest over time. So here's like the hybrid, right? So some people say, well, I really want to do the 15-year mortgage, right? And let's say that they have consistent cash flow right now, but moving forward, maybe a lot of that cash flow to be able to cover that $25,000 a year. Sorry, what was it? It was, so yeah, that $28,000 a year, that 15-year, they have stable income to pay that now. But what were to happen if that family maybe lost a job, right? Or, there was some type of recession, they got to scale back. And the one thing that's really hard to do, especially during like a market downturn, you just lost your job, is guess what? It's really hard to take a 15-year mortgage, right? And then turn that into a 30-year. Whereas right here, I've shown you can turn a 30-year mortgage into a 15, right? So let's say that you wanted to pay off your house in 15 years, right? But you're willing to actually pay for the flexibility to turn it effectively into a 30-year when times get tough, right? You lost your job, or whatever circumstance happens, you say, we need to tighten our belt in terms of our cash flow a little bit. This is kind of a hybrid approach you can consider, right? I've taken a 30-year mortgage, right? So I've taken the 3%, right, over 30 years. But what I've done here is I'm effectively going to pay it off in 15 years by increasing my mortgage payment from $1,475 to $2,417. So I'm paying an additional $1,000 a month to pay the 30-year mortgage off in 15 years. But what's really nice, right, is that, times get tough. This is a fixed payment that you have. This $1,475 is fixed, and you've been making a 24. So when times get tough, you can slow down. You can stop paying that additional $1,000, right, to have a little bit more what I call flexibility in your mortgage, right? So by doing that, there's a cost to doing this, primarily because the mortgage rates are different for the 30 versus the 15. So down here, I'll share this in the group. I actually created this calculator, so you can just type in these three numbers and it gives you everything else. It's fun. But if you were to do the 30-year mortgage and plan to pay it off in 15 years, the cost of that flexibility, right? You're going to be able to slow down and pay about $900 less per month. Let's see if I got that right. Yeah, that's right. So yeah, you're going to have the ability to slow down from paying it off in 15 years to now paying it off, kind of going back to the 30-year minimal mortgage payment. So you free up about $900 a month moving forward. But here's the deal: because that interest rate was higher with a 30-year, you're going to effectively pay $15,000 over the total life of the loan by doing that. So if you were to get this 30-year mortgage and actually not pay it off in 15 years, right? Then and pay it off in 15 years, you're going to pay an additional $15,000 over the life of that 15-year loan, which, and on an annual basis, you're paying $1,000. Yeah, I do say fun and right a lot. Facebook user. So annual cost is $1,000 to have that flexibility, which comes to a monthly cost of, you are paying $83 a month for the option to slow down and make your payment a little bit less versus just straight up taking the 15 from the beginning. So I'll use the word fun again and say that's a fun option if you like to go the hybrid route. So this is so fun. Okay, let me go back up. So there's this big debate about, hey, should I pay off my debt faster? Should I be more aggressive with my debt repayment? Or should I invest more into the stock market typically, or invest into other opportunities? So one thing that's really missed in this whole debate of pay off debt versus invest is thinking about money in terms of time. Actually, we're going to be taking a rational approach here. So most families, when they say, hey, like, I'd rather pay minimally on my debt and invest the rest, they're usually talking about investing in the stock market. So I've taken this, just look over there. I've taken the historical risk and return measures of the S&P 500 going back to 1926. So a long time. So you can see I'll zoom in here. Any money nerds out there will like this. So this is a graph. This is a chart that Dimensional Funds comes out with every year. It's called the Matrix book. If you want to Google it, it's called the Dimensional Matrix. And every year they come out with this book that shows what the annualized return over every period in different stock market indices have been. So I've taken this chart, which is a lot of numbers, and I've gone up here and I've turned it into a chart with less numbers. So I did you a favor. So I've looked at the historical the range of annualized returns over different rolling periods invested in the S&P 500 US stock market index. So the reason I say to look at money in terms of time is, let's say that you had a 3-year car loan, right? You have 3 years on your car loan right here. I'll just highlight, maybe I can, there we go. So you have 3 years left on your car loan, or you just got a new car loan for 3 years, right? You might be tempted to say, oh, well, the rate on my, the interest rate on my car loan is only 3%. So like, I'm definitely going to make more in the market than this. I'm definitely going to make more than 3% in the market than paying, than this interest rate, right? But what you'll notice is over only a 3-year period, you're taking historically a bet, right? So over the stock market, over the 90 so years here, over a 3-year period, rolling period, the range of annualized returns are from negative 27% to 31% positive. So just to give you an example, that negative 27 sounds pretty harsh just alone. But if I even take a 3-year, over 3 years, let me do this. So over 3 years, though, that actually ends up being a cumulative negative 61% return, right? So you can see that, yes, that was definitely during, probably during the, the Great Depression, for an example, right? But it certainly is possible. There's no guarantee of future results. I'd definitely be amiss not to mention that in our call, right? But the range of annualized returns over a 3-year period historically have been as low as 27% annualized, but up to, there's still definitely some upside of 31% per year. That's a spread. So negative 27 all the way to positive 31. That's a spread of 58% between. And over every rolling period, over every 3-year rolling period that the stock market has been happening in terms of that index, we've had 16% of that time, there were periods of negative returns cumulatively over that period. So the reason I say that is a 3-year, deciding to invest versus paying off a 3-year loan is very, very different historically than paying off a 30-year loan, a fixed rate loan. What's really wild about this chart is that you'll realize that, again, there's no guarantee of future results, but historically, investing over a 15-year period, again, you have to have the discipline to stay invested and continue to invest. Stay in the market, right? We talk about time in the market versus timing the market. This is that chart right here. Time in the market over a 15-year period, no guarantee of future results. Over every 15-year rolling period, invest in the stock market, you've had positive returns. Not every year, every year it's up and down. You have negative years, positive years, but if you take the whole cumulative 15 years and then annualize that back, you've had 0% historical periods of negative return. And the reason that a lot of families right now are deciding to pay minimally on a 30-year mortgage, for example, versus paying off, versus paying more principal, making additional principal payments, is that they're looking at, hey, over a 30-year period invested in the S&P 500 historically, it's never been annualized less than 8.5%. So a lot of families who are paying minimally, they're taking that bet. They're taking on that risk to say, I think it's probably going to be, it's maybe going to be like it's been in the past. And as long as I have the discipline to stay invested over those 30 years. And the interesting part here is when we say invest the rest, that's the big part. The discipline is usually missing to actually invest the rest. Most families who say, I'm going to pay minimally on my mortgage and invest the rest, since they don't give every dollar a job, right? Since they don't take control of where that money actually ends up going, it ends up buying, more Taco Bell or whatever it ends up buying, right? So again, if you're going to take that risk of paying minimally and take that leverage to look for greater investment opportunity, you have to have the discipline to actually invest that money and stay invested over that period. One thing that I should mention, right, is this is the rational approach. And Andy loves Taco Bell. Me too. Bean burritos all day, no onions. So this is the rational approach to investing versus paying off the debt faster. But we shouldn't ignore the reasonable side, which is the personal side of finance. For those who are risk averse, right? They don't necessarily want to be, in debt to the lender, through the rest of their life. They're like, I want to do the debt-free scream or whatever you end up being passionate about. I love how we're having a Taco Bell discussion. So some families just like the idea of, hey, like, I'd love to be out of debt. Like, one, it frees me from just that, not just feeling like I'm kind of, burdened somehow. There might be shame, maybe historically in the family, there might be regret around previous debt. Like, we can't ignore that reasonable approach to paying off debt. And on top of that, where was I going here? Oh, and on top of the kind of emotional behavioral side of paying off debt, like we also need to think about, what is that cash flow? What does that freedom of future cash flow mean? When we go back up to this example of, hey, like, I could pay an additional $1,500 a month to pay off my mortgage faster, right? That means that if I pay off my mortgage by age 64 rather than 79 minus 64, I'm going to have an additional 15 years of not having to make that $25,000 a year payment. So, yes, you can go into the fully rational investing side of the equation, or you can go fully, behavioral, emotionally, how you feel about debt, risk tolerance versus risk capacity. But I think it's really good to have these conversations with your family of saying, hey, like, now we know both sides of the equation, how we feel, and what's the rational side of, like, how much historical risk are we taking over this debt repayment period. And now you can make really a well-informed decision rather than just doing what other people may have told you to do, whether, from other financial media, or let's say a lot, even people on the Facebook group. If you say, hey, should I pay off my debt or invest the rest? Most people will simply tell you what to do, tell you what they would do, rather than understanding your comprehensive financial situation, personal values and objectives, to make a well-informed decision. So I would love, I'll share all these resources. And then I think this PDF has also been shared. I'll go ahead and go back to the let's see. Debt is dumb. Cash is king. That's right. No, just kidding. I know you've got some Dave Ramsey fans in here. So I'm going to go ahead and sort through a few of the comments since we're getting close to the hour here. Oh, good. I can see all of them, Andy. Let's see. If I haven't answered a specific question, you can go ahead and type that in one more time. Besides Andy Panko not having Taco Bell. Let's see. Yeah, I really love that phrase, give every dollar a job. Another phrase is give every dollar a use by date. So every dollar, anytime you invest money, you should have an idea of when you're going to need that money again. A lot of people investing, especially things like crypto and anything more aggressive right now, maybe they're thinking like a very abundance mindset. They're thinking like, oh, wow, like get rich fast. But before you invest in anything, you have to have a not just a rebalancing strategy, but understanding, when am I going to take this money back out to live? Once you give every dollar a use by date, you then have a really good idea of how much risk you need objective, risk in terms of risk capacity, how much risk you should take with the money that you're investing. I like using Portfolio Visualizer if you're looking at any historical returns over different periods of time. Like for example, when we looked at the 5-year versus 30-year, those type of metrics, portfoliovisualizer.com is a free resource to look at what different asset classes or even certain tickers, if they've been around long enough, you can look at information there. Any advice on shopping for a refi? So I've heard a lot of different things here. So certainly right now, if you're going to investigate a refinance, I would personally say if you have if your mortgage is at 4% or higher, fixed rate mortgage, certainly there's a lot of variables. I can't go through all of them right now, but that's kind of in my mind. As soon as I see 4% or higher, to go, maybe we should think about, or just at least get some quotes on refinancing. You could certainly just contact the lender you're already with to say, hey, like, can you what are your will you do any refinancing without additional closing cost, without paying additional points? Like, what can you work with me here? There's also something called recast, where if you've paid additional principal in the past, you might be able to kind of recast your mortgage back to the original debt repayment period, but have a lower monthly payment. Thank you, Mark. Appreciate that. So refinancing, I personally, I always go to the same person. I'm not compensated for anything, but I did mine through Loan Depot. I found somebody in the group that was willing to share education with me and really go deeper and give me all the different quotes so I can analyze them myself. You might want to start with your local credit union or where you already bank. If you already have a relationship, kind of trust with that lender. One common misconception is that a lot of people retire and then they fear that if they retire, they're not going to be able to get a mortgage after that. But in reality, usually most mortgage lenders, they have kind of criteria, but as long as you can prove that you have some type of recurring payment, right, or recurring income from some source, like let's say that it's Social Security or like recurring distributions from your retirement accounts, right? If you have even before 59 and a half, if you can show them that you have equally substantial periodic payments, or show them some type of a trail of, yes, income's coming in to cover the mortgage, at least for the next year, I think it's like in the next year or two, then you can still refinance, you can still get a mortgage in retirement. It just might make a little bit more. Oh, I didn't plug in my keyword. I'm so sorry. Yeah. So sorry, I lose my train of thought there. But yeah, go ahead and have these conversations about refinance. Again, doing the analysis and asking questions. You don't have to pull the trigger, right? I think the number one advice I would give about refinancing is do not go on one of those websites to just type in your name and your phone number, because within 5 seconds you will have a phone call from somebody you never want to talk to ever again. So yeah, definitely start with who you know. Start local. Try to find a lender who you'll talk to the same person every time. Which for me, I have a contact at Loan Depot. Certainly, just again, you can ask people in this community. I'm sure they'd be glad to help. In the absence of steady monthly income like Social Security, pension, will large investment account size alone be enough? Yes. I think the number is, since I'm not sharing my screen, I definitely have a PDF of this. Oh, yes, I'm going to read it to you. How about that? Okay. Just real fast, I have a summary of mortgage and retirement. So I'll just quickly read this to you. So underwriting guidelines emphasize the continuity of a borrower's stable income. Borrowers who derive income from 401ks, IRAs, and other variable investment accounts must document that it is expected to continue for at least 3 years, there's a number, for at least 3 years after the date of their mortgage application. Lenders can use 70% of the value of those accounts to determine how many adequate distributions would remain, since the accounts are subject to volatility. The accounts must also have unrestricted access without penalty. There's a big one, right? Retirement accounts before 59 and a half. You might have to, prove to them, hey, I'm using the rule of 55, right? I retired in or after the year I was age 55, examples like that. Social Security can also be documented, but of course, not until you claim your benefit. You can't say, hey, I have the option to claim, right? You have to actually claim that benefit and show that income's coming through. Accounts that hold securities require an account statement that verifies the value and ownership of the assets. If you're using a financial advisor, right? If you already have a relationship with an advisor, they can. I've done this before. They can actually write a, on their letterhead, they can write a note to the lender saying, "Hey, I verified that they have the assets, and our relationship. We can support that income flow moving forward." To just give them more confidence that you will be a stable lender. A stable mortgager. So proceeds from the sale of real property can also be used to provide, if you provide a settlement or closing disclosure statement. So let's say you're selling a house to buy a house. Like, they can help you through that process of saying, "Hey, you can get a mortgage because we know that you're selling that other property. You're then going to have the cash to create those distributions as needed." So my last note here is develop a relationship with your mortgage lender months before you begin the underwriting process to ensure that you have all the required documents in place. How about a legitimate site for insurance quotes? I wish I had them. Please share them in the comments if you have more what they call legitimate insurance quotes. Yeah, as David Meyer says, some custodians can auto-generate such a document saying so-and-so has such and such assets. I think when I did it, it was called a proof of recurring income that I had to sign as a lender. Insurance broker. Yeah, if anybody has, without going into DMs and stuff, if anybody has advice about, more insurance broker who's hopefully not you within the group, that would be great. All right. So if there are no other questions, I think, let me tell you, I'm going to tell you real fast what my topics may be for next time. Stick with me. Thank you, Facebook users. I wish I could see everybody's name. I can only see David Myers, David Foltz, and Andy for the most part. So I've outlined about 38 topics so far, but next topics. I'm going to show how to review a pay statement, how to review employee benefits, how to review an HSA, a health savings account statement, and really options with your HSA kind of to and through retirement. Then I'm going to go a little bit more into how to understand how to review tax returns, tax statements, and how to review your 401k statement, for example. I'm going to share into so the dimensional matrix. After this video, I'll post in the comments the dimensional matrix book, since you want to be really nerdy with all the graphs they make. But appreciate everybody being here, and I will see you in a month with, I think, how to review your pay statement and employee benefits. So I'll see you soon. Take care.